Can just 10,000 Indian rupees really turn into millions? It sounds impossible, but with the power of compounding, smart investing, and time, even a small amount can grow into life-changing wealth. In this video, we'll break down how ordinary people use simple strategies to build extraordinary results, and how starting small today could make you a millionaire in the future. Today we will talk about how 10,000 Indian rupees can grow into millions. So before we start, make sure to hit the like button and subscribe to my channel. 1. The power of starting small. Many people believe that becoming wealthy requires a huge salary, a business empire, or a lottery win. However, history has repeatedly shown that wealth is often built through consistency, patience, and smart financial decisions rather than massive starting capital. A simple amount like 10,000 Indian rupees may seem too small to create meaningful wealth, but when invested wisely and given enough time, it can become the foundation of financial freedom. The biggest advantage an investor can have is not money, it is time. Time allows investments to multiply through the incredible force of compounding. For example, if 10,000 Indian rupees is invested at an average annual return of 15%, it can grow to nearly 1.64 Indian rupees lakh in 20 years without adding a single extra rupee. At 20% annual growth, that same 10,000 Indian rupees becomes more than 3.83 Indian rupees lakh. Now imagine adding regular investments every month. Even a small SIP of 2,000 Indian rupees per month can turn into crores over a long period. The secret is not how much you start with, but how early you begin and how disciplined you remain throughout the journey. 2. Understanding the magic of compounding. Compounding is often called the eighth wonder of the world because it allows money to grow exponentially over time. In simple words, compounding means earning returns not only on your original investment, but also on the returns already generated. This creates a snowball effect where wealth accelerates as time passes. Suppose you invest 10,000 Indian rupees in a mutual fund that gives an average return of 12% annually. In the first year, your investment grows to 11,200 Indian rupees. In the second year, the 12% return is calculated on 11,200 Indian rupees instead of the original 10,000 Indian rupees. Over decades, this effect becomes extremely powerful. A person who starts investing at age 20 can accumulate far more wealth than someone who starts at 35, even if the second person invests more money. Time is the real multiplier. This is why financial experts always encourage young investors to start early. The earlier the money enters the market, the more time compounding has to work. Compounding rewards patience, discipline, and consistency, which are the true ingredients of long-term wealth creation. 3. Choosing the right investment vehicle. The journey from 10,000 Indian rupees to millions depends heavily on where the money is invested. Keeping cash in a savings account may provide safety, but inflation slowly reduces its purchasing power. To create real wealth, money must be invested in assets capable of generating higher returns over time. Equity mutual funds, stocks, index funds, exchange-traded funds, and even certain business ventures have historically delivered strong, long-term growth. For beginners, mutual funds are often considered one of the safest and easiest entry points because professional fund managers handle the investments. A well-diversified equity mutual fund in India has historically generated returns between 12% and 18% annually over long periods. Index funds are another excellent option because they track major indices like the Nifty 50 or Sensex while keeping costs low. Some investors may choose individual stocks, but this requires deeper knowledge and risk management. The key is to invest in assets that grow faster than inflation while remaining patient during market fluctuations. Wealth is rarely created overnight. It is built gradually through smart decisions and long-term thinking. 4. The importance of discipline and consistency. One of the biggest reasons why many people fail to build wealth is not lack of income, but lack of discipline. Investing 10,000 Indian rupees once is helpful, but regularly adding more money is what creates extraordinary results. Imagine investing 10,000 Indian rupees initially and then contributing 5,000 Indian rupees every month through a systematic investment plan, SIP. If the portfolio earns an average annual return of 15%, the investment could grow to over 1 Indian rupee crore in around 25 years. This demonstrates how consistency can outperform even large one-time investments. Financial success does not depend on market timing. It depends on time in the market. Many investors make the mistake of panicking during market crashes and selling their investments. However, successful investors understand that market downturns are temporary. In fact, crashes often create opportunities to buy quality assets at lower prices. Discipline means continuing to invest during both good times and bad times. It means resisting emotional decisions and focusing on long-term goals rather than short-term market movements. Wealth creation is less about intelligence and more about behavior. 5. Inflation, the hidden enemy of wealth. One crucial factor that every investor must understand is inflation. Inflation refers to the gradual increase in prices over time, which reduces the purchasing power of money. For example, something that costs 100 Indian rupees today may cost 200 Indian rupees or more in the future. If your money grows slower than inflation, you are effectively losing wealth, even if your bank balance appears larger. This is why simply saving money is not enough. Investments must generate returns higher than the inflation rate. In India, inflation has historically averaged around 5% to 7% annually. A savings account giving 3% to 4% interest cannot protect wealth effectively in the long run. However, equity investments have historically outperformed inflation significantly over extended periods. This is why investors aiming to turn 10,000 Indian rupees into millions must focus on growth-oriented assets rather than low-return instruments alone. Understanding inflation changes the mindset from saving money to growing money. Wealthy individuals do not let their money sit idle. They make it work continuously through productive investments. 6. The role of risk and patience. Every investment carries some level of risk, and understanding risk is essential for wealth creation. Higher returns usually come with higher volatility. Stock markets can rise sharply and also fall dramatically during economic crises. Many beginners become discouraged when they see temporary losses, but experienced investors know that volatility is a normal part of long-term investing. Historically, markets have always recovered from crashes and continued growing over time. Patience is what separates successful investors from unsuccessful ones. Warren Buffett, one of the world's richest investors, built most of his wealth after the age of 50 because compounding accelerated over decades. This highlights an important truth. Wealth creation is a marathon, not a sprint. Investors who remain calm during uncertainty and continue investing consistently often achieve remarkable financial growth. Risk can also be managed through diversification, which means spreading investments across multiple assets instead of relying on a single stock or sector. 7. Building multiple streams of investment. Turning 10,000 Indian rupees into millions becomes even more achievable when investors expand beyond a single income source. Smart investors gradually build multiple streams of income and investment. For example, someone may begin with mutual funds and later invest in stocks, digital businesses, real estate investment trusts, REITs, or dividend-paying companies. Dividend income can be reinvested to purchase additional shares, increasing the power of compounding further. Some investors also use side hustles or freelancing income to increase monthly investments. Technology has made investing more accessible than ever before. Today, anyone with a smartphone and internet connection can open an investment account within minutes and start building wealth. Financial literacy is becoming one of the most valuable skills in the modern world. The more knowledge a person gains about money management, the more opportunities they can identify. But if you like this video and would like to see more like it, please give it a thumbs up, leave a comment, and click the button to subscribe.